Financial Argument. Follow us on YouTube.
Joining us today is our good friend, Jim Willie. He's the editor of the Hat Trick Letter found on goldenjackass.com. Jim, it's a historic morning, and it's great to have you back in the show.
It is a big day, and it took me a little by surprise. I was expecting a bunch of fraud yesterday, but apparently the system was set up in Britain with thousands of volunteers to do hand counting of the ballots, and it made any attempts by machines like the United States relies on for vote fraud, it made it very difficult. So now we're going to have all the scare tactics end. We're going to have the reality come into view, and it's just great to see the gold price up. It's up over $50, almost $55.
Yeah, at one point overnight, Jim, it was up over $100 in dollar terms, and it was up nearly 25% in pound sterling. As for anyone who slept in this morning or wasn't up late last night, huge shock. Brexit leave vote won, and it's shaken markets to their core.
Yeah, that's all good. I mean, I know there's a burst, but it has to settle, and the machines have to come in and register their rigged gold price. But I'm a little disappointed silver's not over 18 when it touched 18 back in April. So we got a little catch up to do with silver. It'll come in because it's absurdly out of balance. But anyway, back to some of the main points here. I think if I had to summarize in a single sentence what happened, I think the British were sick of seeing their sovereignty gone away and sick of the European fascist state. So they wanted to take control of their country, take control of say, important trade deals, and just go their own course again. Britain has never signed up in its long history, has never taken a second seat to anything, and to the pedophiles in Brussels, that's just not going to last, and it did not last. I don't know exactly when this takes effect. I'm thinking it's in 3 to 6 months, but I'm looking for a lot of Russian trade deals to come in. I'm looking for some financial platforms to be solidified by China in London. So it's going to be really quite interesting. I think we're going to see a follow-on vote to render damage to the dollar and get rid of the fiat paper currency system. This move in gold, if it sticks above 1,300 in the next couple of days, we're going to get a resumption because of short covering. Those who were short on gold close to 1,300, expecting the Remain vote to prevail, they're hoping and praying that it comes back down, and if it does not in the next 24 hours, they're going to have to cover their shorts for a loss, and that's usually how the continuation takes a second gear. Going to be interesting, John. I mean, there's so much more. There's going to be, I think, a casualty real soon in Deutsche Bank. A colleague of mine just pointed out that they have $33 trillion in interest rate derivatives. This is Deutsche Bank. And $6.3 trillion worth of currency derivatives. We have a big move in the U.S. Treasury bond, down to 1.5% on the 10-year. We got big moves all over the board in currencies. And there's one thing that derivatives cannot tolerate, and that's big moves. Then you're going to have a lot of pressure, I think, on other European Union member states to also exit. And it could be Netherlands, as you were saying before, but there's more. There's Denmark, there's Poland, there's Czech Republic, but Netherlands is big. They're a lot bigger than Poland for importance. But Poland is important for a military standpoint because it's a staging ground for the U.S. military in NATO. But look for some important new rebellion taking some momentum, and there's going to be a lot of criticism of the European commissioners. They've tried to ram down the throats of a lot of countries, the Ukraine war, the Russian sanctions, the Monsanto GMO foods, the Transatlantic Trade Investment Partnership Trade Union. None of the member states want any of them. So the dictatorship of Brussels could be forcing this string of referendum votes. I thought this British exit was a lot more than just Britain taking control of their country. It was a rejection of the fascist state that has arisen in Europe.
So, Jim, I got to ask you, how did the elite let this happen? I mean, it took you by surprise, the result. It took me by surprise, and it certainly took the markets by surprise entirely. So how did the elite let this happen? And do you think there's any chance that they're pulling the plug on the financial system and going to use Brexit as a scapegoat for, see, this is the reason why the everything collapsed?
Well, they might, but how did they let it happen? I think an important event took place about a year ago when the Scots attempted to do an independence, and the referendum vote was rigged. And the observers noticed how they did the rigging, and therefore, I'm told by London Paul, there were tens of thousands of volunteers to hand count the vote. So what they did essentially was they just made impossible a rigged vote. Now they could have done what the United States often does, is rig the software and make it illegal to challenge the Diebold no bid contracts for the voting fraudulent software, or they could do what Obama did, which was to ship in maybe over 1,000 Somalis into Ohio to vote for Obama illegally without proper registration. Or they could have, like in Philadelphia and other places in the East, big black guys preventing white folks from voting at all in black districts. But it seems like, and I mentioned this in a recent interview, the vote rigging could be good for maybe 5 or 6%. And I think that even though we're seeing it's like 52% now for leave, I think without the rig, it might have been closer to 60. So it wasn't enough. If there was, whatever it was on the vote fraud, it wasn't enough to overcome a huge advantage. And maybe the elite think that they could take advantage of this exit. I don't think they will, because they're going to see now the gold price go up. They're going to see the currencies in turmoil. They're going to see the bank derivatives upside down. But they also might, John, have been afraid that if they allowed a rig to take place and the Remain to prevail and win, the elites might have been afraid of pitchforks, because there's a lot of groundswell resistance and anger and angst, and a lot of people are angry. And I think they're angry at the trend of war and a fascist dictatorship. The food issue over GMO food labeling, it's very big in Europe. The Russian sanctions, probably bigger, maybe not bigger, but I think probably bigger. There's a lot of real strong resentment across all of Europe, including England. And this is a focal point. And it's good. It's good for the people to have their vote count. We're going to see some very weird things now. I think the British pound is going to get hit for a while, but it's going to rebound just like the Russian ruble did. But watch the TNX, the 10-year yield on the U.S. Treasury. It's down to 1.5, and my Euroraj has said, Jim, you got to mention this, because it was back in January and February, you were mentioning that the Treasury bond will move from 1.9 down to 1.5 with the big black hole of the dollar and treasuries. I call it the Keynesian black hole. If the Fed is caught in a trap with no monetary policy options, they cannot raise interest rates, they cannot stop the QE bond purchase programs. How is it going to be played out? To be played out an implosion and a movement into the Treasury bonds and the black hole. Euroraj thinks we're going to go down from 1.57, 1.6 right now on the 10-year. He thinks we're going to go down to about 1.3. And I agree. Well, he's smarter than I am. I tend not to disagree when he says something and pounds the table. He's a professional at this, and I'm just a lowly newsletter writer.
So, Jim, I mean, we've been talking the last few months about an impending commodities derivatives crisis. I mean, a lot of that with Deutsche Bank's problems, we can tie that to Glencore and everything we've been seeing there. So throw in the currency derivatives now. So are we facing a two-headed derivatives monster of both the commodities derivatives as well as currency bond derivatives now?
I think so, yes. We've had the impact of the energy derivatives. We've seen the damage to the big banks for their credit portfolios. Now it's time we see some damage from the interest rate derivatives. You cannot have a big move like this in treasuries. If we continue down and we get into a 1.4 handle on the 10-year bond, you cannot avoid derivative damage. And with all the movements between the euro and the British pound and the euro and the dollar, all these movements are very dangerous for derivatives. I like making a comparison, and it's a very accurate one to make. The comparison is the derivatives are like a very high, huge tower. And with more and more leverage, you reduce the size of its base. So a smaller footprint and more swaying with the wind. And it doesn't matter if the tower moves left or right or front or back. Movement, like 150 stories up. Movement from the winds for these derivative towers causes tremendous instability. And we saw some instability way back in June of 2012 with the London whale and the interest rate derivatives, because we had huge moves in the treasuries from about 2.4, I think, down to 1.9. Okay, this move now is not quite as big, but there might have been some beliefs that we just couldn't get below 1.7%, so they made a bigger, stronger wall that's breaking. But all these movements in currencies and movements in interest rates are really bad for the derivatives out there. And two other points to make. Back in December, we had an interest rate hike, or supposedly an interest rate hike. But really what it was is an adjustment for the reverse repo, where the central bank, the Fed, took cash. That's the reverse part. Took cash from the Wall Street banks and in return gave them treasuries with which they could increase their leverage. In other words, make the Tower of Babel even higher in Wall Street. And now that even high, since the interest rate hike, whatever the heck it was, I think it was a fake hike, because the effective Fed funds rate didn't really move much. Okay, so the reverse repo was the goal there. In other words, their whole motive was to increase the leverage in Wall Street Treasury bonds. Well, now you're seeing exactly what they don't want to happen, and that's big moves in the treasuries. Okay, now all these events also in the forex, in the foreign exchange, the currency markets, with the euro, the pound, sterling, and the dollar, and probably more. These are not good for derivatives. They cause tremendous problems. And where is the problem going to be seen but Deutsche Bank? They've got huge interest rate derivatives. They've got very big currency derivatives. And they're down 20% today on their stock. They've been at death's door for quite a while. And now I think they might be carried off into the morgue.
So, Jim, I mean, how concerned are you over Deutsche Bank here in the immediate short term, say the next 5 to 7 business days? I mean, when we're talking about moves in currencies, I mean, 100 basis points is a large move typically. The pound was down nearly 11% last night.
That's horrible for the derivatives, and the whole central focus, the office for derivatives in Europe is Deutsche Bank. Since they acquired by force the Bankers Trust in, I think, 1998, they became the European outpost for all of Wall Street's derivatives on the European side. And I think Deutsche Bank is going to fail. It might happen very soon, but if you're looking for some of the consequences, even without a Deutsche Bank failure, you might see their own very weak position causing failures in some of the Southern European, known as PIGs, member nation banks, like Italy. Italy and Spain and Portugal, they're at tremendous risk, and anyone who doesn't include France in with Italy, Spain, and Portugal is very much errant. France looks just like Italy. But, you know, they've got a higher position in their offices. Now, I think we're going to see some bank events as a result of the big movements in currencies and sovereign bonds and the effect it has on Deutsche Bank. Deutsche Bank's going to have a hard time holding on, along with the Euro Central Bank, holding on the Italian banks. They're big. They're so incredibly insolvent. They got something like 30% non-performing loans. Enormous non-performing loan ratio in Italy. Okay, the focus is now on England, but watch in the shadows Italian banks fall. They're having a tremendously difficult time. They set up an Atlas fund, I think it was in early May, and they loaded it up with a mere $5 billion for handling the bad bank situation in Italy. What got exhausted in a couple of weeks? They cannot fix the Italian banks. They're too insolvent, and their economy has gone to hell. And they've raised the taxes. They're doing everything wrong. Oh, God. So the chain goes sovereign bond, namely the treasuries. The treasuries and the currency market, it hits Deutsche Bank, puts pressure on the Euro Central Bank, and the effect is felt in Southern European banks, primarily in Italy. So look for an event in Italy, and if something happens in Italy, look for a French bank to fail. Because the French are like the anchors, along with Deutsche Bank, for Southern Europe. So those are the pressure points, John.
All right, let's turn the focus back to gold and silver, Jim. Since the news came out early this morning, we mentioned already gold was up $100, and it's off a little bit of that, but it's consolidating still above last year's high. And as we record here going on noon Eastern, it's actually, it looks like it's starting to move higher again, trading close to 1320 again. It had traded, I think, down to around 1310. And as you mentioned, a little bit disappointing that silver hasn't yet pierced through 1800, but in my mind, I think gold will drag silver right along with it, as if we make a weekly close here today above 1310, I think we're setting up for a move to 1400 rather quickly next week. And really, there's not too much resistance at all here between these levels and really about the 1600 level that was such significant support way back 2 to 3 years ago before it was broken down and then gold traded all the way down just below 1100. So what's your take here on the implications to gold and silver and what the metals look like here going forward? It certainly looks to me like we're in the early stages of a major new bull move.
I think we're moving into second gear for 2016. The first gear was pretty clear in January and February. We got off the multi-year low in gold, and now I think we're ready for a second gear to move us well past the 1300 mark. And you know, once you get past 1300, there's not a lot of resistance out there, and I don't see a lot of this. To be sure, there'd be resistance points, but we didn't spend a lot of time, like a full year, banging around at 1500. We went rather quickly from 1900 back down to 1300 a few years ago. And I think we're going to make a rather quick move toward 1900. I cannot say when. I cannot say how. I just think it's going to happen. But there's going to be an interesting phenomenon taking place just in the next day or two. As big traders who shorted near 1300, they're going to have to cover. So look for a continuation rally to get some real mustard moving. Like if it doesn't, I noticed that for the last hour and a half, it really hasn't changed much. A couple dollars here and there for gold. That's a really good stable sign. Hasn't changed much for silver either. In fact, silver looks better now than it did last night. So I think we're going to see some short cover burst rally. But let's get to some very interesting and deadly points, and that is the paper ratio per physical ounce. I think we've moved from 200 something to over 400 paper claims per gold ounce physical, which means that for every physical ounce of gold out there, including all the bars and everything in the COMEX, etc., there are over 400 and close to 500 different claims. Now, what happens to a house auction if you've got only one seller and 400 people bidding on it, eager to get it? Price goes up. Okay, now what's been remarkable in the last month or two is that the silver physical ratio, paper ratio to physical silver, has also gone way up. It's like 40 now. And that's a lot more important than the gold ratio of paper to physical. The silver ratio is more important because it has tremendous uses and demand and application in industry. And lately the big focal point has been silver dust and guaranteeing silver inputs for the photovoltaic, the solar industry. Okay, so we're going to see a lot of movement, I think, in silver real soon as it's certain that the gold price advance is going to stick. There's something that people really need to focus on regarding silver. If you just consider, and this is something that you can remark on because it's right up your alley, if you look at just the silver eagle coins in the United States and just the silver maple coins of Canada and the demand for those coins, and then you compare it with just the North American, U.S. and Canada rather, just the U.S. and Canada mining output for silver, there's a 33 to 35 million ounce deficit. There's more coin demand in U.S. and Canada than there is mine output, and that has completely apart, that argument is completely apart from industrial demand in the U.S. and Canada. So the shortage and deficit in silver is monstrous. I think we're going to see a five-fold gain in the silver price rapidly, and I can't say when. People keep asking me when, and sometimes they say, well, probably by August 45th. Oh, but Jim, there isn't any date. I said, exactly, we don't know. It depends on how much more corruption they're going to add to the picture. Depends on whether they add another war. Depends on whether the Vatican releases more silver supply. I'm hearing the Vatican in Basel, Switzerland have basically said no more. No more. We're not going to bail out the system anymore. We're not going to relieve ourselves of the wealth. And there's a really good reason for that. Because apart from Basel and the Vatican, almost every other party has relinquished their gold and silver to support the dollar and the paper currency system. So Basel and the Vatican are basically saying we're going to remain in control because all of our competitors have done the stupid thing of relinquishing all their gold. Very important. The deficits are enormous. You have close to 500 paper claims per ounce of gold. You have about 40 paper claims per ounce of silver. These need to be resolved. We have absolutely no equilibrium whatsoever in the gold and silver markets. And what this Brexit vote will do is force some movement toward equilibrium. And until you see a number of mines open again, mining projects open again, where new mining supply can come back into the system, unless you hear that, we got a long way to go. I think you're going to see some equilibrium, very low level equilibrium, above 2,000 gold, above 50, 60 silver. And then comes the march for the gold currencies and gold trade notes. You cannot have a gold trade note to guarantee a transaction in import-export, which would no longer soon be in treasury bills. You can't have a gold trade note without gold behind the system in vaults. So we got some new systems coming in place. We got equilibrium to restore. We got deficits to get rid of. It all translates to much higher gold price, and whatever gold rises in percent, just figure double or triple that for silver. The voice has told me that he tells his clients, he advises his multi-million-dollar clients to go 90% silver, 10% gold. I say 80% silver, 10% gold, 20% gold, but that's, fine point differences.
Yeah, I certainly concur with your thoughts, and wouldn't be surprised at all to see gold especially move rapidly, almost like a magnet or a beach ball held underwater, sucked back up towards that 1600 level over the next 2 to 3 months. Is just my personal thought looking at the market here. And like you said, there's just a big gap as far as any significant resistance level, because gold didn't trade at the 1400 level, or really anywhere between 1300 and 1600 for any length of period.
And that's really important, because it's something that's lost on a lot of individuals. If you didn't have a battle, say between 1450 and 1550, you had no battle at all in, say, the year 2013, 2012, there's no battle at all, then there's no person in there, there's no entity in there, there's no big participant in there who's going to try to defend his position or his company's position. And the price just moves like there's nobody in the road to stop the car. That's what resistance is all about. If a lot of people bought, like right now, a lot of people bought at 1300, and they've been down for over a year. They're getting out now. They're saying, oh, what a relief. I can get out. I can sell at 1300. I was down over 10% for over a year, and I was worried sick. They get out. Okay, where are the people going to be at 1500 to get out? There weren't any. That means there's no resistance, no people out there, no big companies and hedge funds and whatever to say, oh, great, it's back to 1500. We've been down $200 and $300 and $400 for the longest time. Let's get out. There aren't any people like that. Well, there might be just a few, but there are legions at 1300. That's what resistance is all about. And there's a countering side to that. Down at the bottom. Every time I bought at 1150 and 1200, I made money. So it's down there again, and I'm going to do it again. And now those same people are watching. If 1300 holds, and we go up to, say, 1370, and come back down to 1320 again in a week or two, they're going to say, looks like 13's going to hold. I'm going to get in, because I made money at 1100 and 1200. The same strategy. It's holding. So I'm going to get in again. I'm going to buy. So the absence of sellers at a higher level and the new people coming in realizing that 1300 is holding, that's where you're going to see the technical traders just continue. But I think it's a lot more than that. Those are just the technical resistance and support arguments on the psychology. I think this is going to be a lot bigger. I think a lot of people, a lot of financial firms out there are realizing this Brexit vote where the British leave, this is a vote against the system. What's the next vote against the system? And I think it's going to be gold against the dollar. A lot of players don't like what's going on with the dollar. They don't like QE. They don't like this African hypermonetary inflation supporting the government, U.S. government debt. They don't like the wars to support the U.S. dollar system. They're seeing the petrodollar as dismantled. And this is a very, very big point we could get into a little bit more. But I believe we're going to see a lot of search by smart players who are going to be concluding the next big play to go gold against the dollar. And another thing is, it looks like big players are standing for gold delivery in July.
Yeah, let's talk about that a little bit here, Jim. I mean, there's been a lot made already of the big players standing for July delivery in gold. And certainly, with all the chaos following a Brexit, we could be looking at a stampede in gold delivery come in July. I mean, this as of prior to 9 a.m. this morning, some of the primary dealers here in the U.S. are running out of gold bullion coins like gold eagles, gold maples. I mean, we're only hours after Brexit, and there's already been a panic into gold coins. And so what's your take here on the COMEX and the potential for some fireworks in July?